Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, as well as Joe Cavatoni, Market Strategist for North America at the World Gold Council, and Chris Englebert, Founding Partner and Chief Investment Officer of Englebert Investment Advisors. And we are here to discuss just about every topic that there is because Joe, I mean, really, the market is trying to figure out what the execution of all of these ideas is going to look like. And we're certainly seeing it reflected in an area that you have expertise in.
Well, look, gold is off to a strong start. And before we start talking about everything that's played out so far in 2025, 2024 was a record year in terms of the demand profiles. Again, central banks at the table, global investors driving the demand, as expected with higher prices, jewelry demand off, consumer off, and a little bit of interest on the technology side as it continues to play a role in the AI developments. But 2025, we're off to a great start, plus 10% returns as we record this, and it's simply because of two main factors: confusion, chaos, and risk abounds, and actually diversification benefits that come by holding gold in your portfolio, and people are understanding, hold my position, wait till we see how things develop, and maybe add to it over time, particularly the Western investors.
My question is, in 2024, if it had a record year when, I mean, the equity markets had a record-breaking year, and right. I understand why it's doing well now in 2025, but why do you think all these asset classes were moving up in tandem with each other? I mean, usually gold's, will move in a different direction.
If you think about gold
right.
the old way, you will think about interest rates only and the US dollar strength or weakness only. What people need to appreciate is that there are other factors at play: geopolitical risks, policy and political factors that are playing into trade-related activities, the questions over the strength of the dollar in the future, the questions over the debt ceiling that's basically on the horizon for the US, and what these central banks are doing and global investors are doing with their own homegrown economic concerns on diversification. Yeah. China had a record year for investment flows. And by the way, China's just announced that they're actually going to pilot a program with insurance companies to allow them to add gold to their portfolios. Talk about an opening up of another major channel and a major use case for gold consumption. Big opportunity in China. So you have to understand it's a global asset, and that's what's driving the price. Yes, Western investors started coming back when rates started showing signs of getting cut by the Fed. We got signaling today that the Fed's going to probably be on hold until inflation is clearer and a cleaner picture. Right. So what are you seeing? A little bit of the gold market backing off during US hours. So it's all being very well understood. You just have to keep thinking global and keep understanding the use cases of the global application of gold. So
Chris, I'm sure you're getting the question, what's the catalyst to move one way or the other? From a technical perspective, you're waiting for the breakout, or what's it going to take?
Well, one of the things that's happening out there, Jill, is that especially people in their retirement plans, which unfortunately gold isn't offered usually in a retirement plan like a 401k. But what's happening is people have a lot of recency bias. So the last couple of years, large cap core, large cap funds have dominated, especially the 401k space. And I've seen retail investors, when they look at their 401k, they go down and they say, hey, this did well last year, this did well last year, and this did, I'm just going to put this and this and this in my 401k. And that's like looking at old football scores or what your team did before. We're trying to tell clients that you've got to diversify away just about everything from large cap growth tech, small, mid cap, international. International's had a huge breakout this year. Nobody had that in their, bingo card, and also fixed income. So again, this myopic view of the, retail and somewhat institutional investors that I got to be only in the S&P or the Nasdaq. Sorry, Nasdaq. But again, diversification is playing the key. And to your point about gold, we haven't seen people really use that as a diversification tool until only recently.
Yeah. Right. And Michael, you wrote about this last Friday after 2 years of U.S. exceptionalism, where it was TINA, right? Mm-hmm. There is no other alternative. And this is a narrative that we're hearing more about, where the risk to the upside is clearly with Europe and ex-U.S.
Yeah, at least to start the year so far. So, and some of it is the trends that have been in place for the U.S., and it's been a bit of Europe catching up to the U.S., more so than the U.S. necessarily slowing down. If we're up 4% in 6 weeks, that's actually not too bad. On pace for a good year. It's just that Europe's gotten ahead of us with things like a bigger recovery in earnings, where they had a bad year for earnings last year versus expected to have positive earnings growth this year, whereas the US, it's more of an incremental increase from where earnings growth was last year to this year. And then you've got things like the DeepSeek, the sector composition stuff where US is more tech focused compared to Europe. So the AI story hurt the US more to start this year than after helping the US a lot over the last 2 years.
I mean, imagine if that narrative wasn't in the market from November 2022 and on.
Yeah, maybe the Europe would have been closer for the last couple years than it was just to start this year.
Yeah,
so.
it really is interesting. But Max, I feel like there is no time for trends to play out. DeepSeek reversed itself in what? Not even a session?
It's completely erased. NVIDIA's back to its highs.
And earnings have been quite good in this
Earnings
environment.
are pretty good. Again, we're starting to see a broadening out. Like we talked about last week, software started to catch a bid. Kind of those second order trades off of the AI cycle. But it's one thing. The actual practice of, we've had head fakes in the past over the past few years where you get these little drawdowns, but they immediately get bid. Everybody thinks, okay, this is the turn. I feel like I'm a broken record here talking about the trade of small caps versus mega cap, that it's going to consolidate. Yeah. You're going to see the bid in small caps. Everybody keeps waiting for it. Oh, here's the signal, it's happening, and then it doesn't. So everybody keeps saying, okay, I was wrong here. I'm just going to stick with what's been working. And until we really see a prolonged period, not just a week or a few days to a week or 2 weeks, where you get a month. I mean, how many quarters? What was it? 16 of the 20 of the last quarters that we've been positive. Until we see a prolonged downturn and a change in what's been working, I think the psychology is going to be stick with it.
It's almost like gamification of buying the dip almost.
Right. It's like, well, buy the dip. It's been working, so you keep getting more and more.
And Chris, you alluded to this point before as well. With recency bias, you could even see it in some of the products that are being introduced into the retail market, where even they might be at a wrapper, but it doesn't necessarily mean that the underlying will work for your portfolio. There hasn't been a prolonged period of volatility. I mean, we had a couple blips on a longer term basis when you look at COVID.
Yeah, Jill, you're exactly right. I mean, to your point, 8 out of the last 9 quarters have been positive. So again, if you look at the last 20 months, 6 months out of the last 20 months have been negative. That's only 6 months. And again, we're getting people, really accelerating this whole, I got to find the next stock that's going to make I got to find the next Palantir. I got to find, everybody's looking for these gigantic wins. But meanwhile, in the background, gold, international, bonds, slow and steady is where the returns are. I'm still very much afraid, and we talked about this a couple of months ago, of that black swan event. I don't know what the trigger is going to be. But when everybody tries to get out the door at the same time, it's not pretty. As a seasoned investment advisor, 87, gives me a little PTSD. 2008 gives me a little PTSD. So again, when the selling starts, the buy the dip, hey, buy the dip has been working the last 2 years. In 2022, it didn't work.
Yeah.
And the question is it going to be something economically that finally tips us over? Trade
Which
war,
makes me a little bit nervous with how investors are thinking about private markets more or alts more when the liquidity profiles are something completely different. And we could have this debate around 60-40 moving to 50-30-20, but when you have underlying assets that are not quite as liquid as we think about ETFs, as we think about stocks, to me it feels very 08-ish, 09-ish, and I don't want to be like the sky is falling, but the whole package product exposure to investments you don't know as much about makes me a little bit nervous.
I tend to agree. If I were to look at the asset classes where we think that naturally the dollars would have gone to us in gold, but they may have gone elsewhere, I think people have been chasing cash balances. And I think the longer we have stickier inflation, the real rate environment actually proves that money should be elsewhere other than cash and money market funds, because we went from 6 to 7 trillion last year. I mean, that's the wrong place for cash right now. I think cash should be in the market. I think gold should be a place where it should be.
Right.
But there's also this ongoing nonstop discussion over privates, equity, fixed income, the debt markets. And there's definitely a piece of that market that makes a lot of sense. But this market's growing so fast, and it's growing with so many different ways of accessing it, with so many people who are thinking they're in it and they can handle it. It's more complex than that. And when you start hearing about the behavior on mark-to-markets and the behavior around sell-offs, and you hear those that are talking about opportunistically buying these dips and those that don't understand it, not understanding what's going on, it worries me a lot. And it's actually a shadow lending market with a lot of sophisticated activities that take place in it, and a lot of people are just jumping in head first. They need to be really careful. So for every dollar you put into private, equity or debt, you should be thinking about a 5, 10, 12% allocation to something like gold, so you can actually deal with liquidity challenges that come along.
Liquidity is the name of the game.
Yeah.
I mean, it's great on the upside, but we're talking about private credit and even equity. When you start seeing mailers going out for retail investors trying to attract retail money into private investments, that's where it gets hairy and scary for me. Because again, it works when everything's going up, great. But like we always see, escalator up, elevator down, and that's in public markets. Now, when you're in a private market and the liquidity's not there and you need to get your money out, what price are you getting? It's much more opaque than obviously the public markets. So that risk, the return needs to be so much greater, in my opinion, for that to take on that risk of really is the unknown of kind of what you're getting into. Everything's kind of packaged up, there's wrappers over it, what are you in? And when you start getting that fervor and the frenzy into those sort of spaces where it's like, hey, this is the next hot thing, let's get involved. But again, liquidity, it's great when it's on the upside, but the name of the game is liquidity when you need to get your money out.
I mean, you could take a look at my inbox and what trends are happening within the marketplace. And I've gotten more pitches on products available to retail investors or, the latest private market platform leveraging AI so that it's more sliceable and diceable, Chris. I don't know. We've been through a couple of ups and downs in this market.
Yeah, I've had 2 calls. I mean, I can tell as a retail RIA, focused RIA, I get all the wholesalers calling me, and it's been nonstop on the private credit, private markets. Like, hey, do you do any of this thing? And I'm like, no, it's really an institutional product because the problem that years ago, and I worked on a giant defined benefit pension plan, they had a big building in Baltimore that was part of their, portfolio. And they wanted to know what they could do. I said, well, the biggest problem you have is that you can't value this, if you had to sell it. And I said, so my suggestion is that you carry it on the books with what you put into it, and then eventually 10 years, 15 years, 20 years down the road, you're going to know what it is. But again, this private credit, it's really institutional for a small slice that you can hang on to until you see the returns. And I guess the follow-up to that is, remember what everybody was worried about a couple of years ago was that the commercial lending market was going to collapse, that everybody was working from home, nobody's going back to the office, et cetera. We still haven't seen that play out almost 3.5, 4 years later. When's that shoe going to drop?
Sure.
So.
Just to jump in with what you're saying. So not my place to tell people how much risk they can take in a portfolio. What I can say with confidence is just look at risk-adjusted returns and look at all the diversifiers that are available for you. Now, that's what's been very interesting about gold. In this whole world of increased risk and everything that's been playing out in the interest rate environment, particularly in the Western markets, you would have thought it would have sold off, but it hasn't because it's globally being consumed. And actually, the Western investor hasn't been dumping it because they know too many shocks can happen too quick, whether it's a bank fail, or a problem with liquidity on any given day, or a need to have an asset that I can move quick out of and into something more appealing that gives me that high level of return. That's where we fit in. And that, again, would be my message. Always look to diversify, always look to add that diversification into gold because of the right kind of diversification benefit.
It just makes me a little bit nervous. I don't want to be cynical about what's necessarily getting dumped on the retail investor. And I know it's a very cynical approach to take, but something that we perhaps have a little bit more visibility into. Michael, longer interest rates, higher interest rates for longer, is that the path that you think we're going to take in 2025?
So far it seems like it, right? The expectation is, if we're going to get somewhere between 1 to 2 rate cuts this year, if you're looking at market pricing, if you're looking the last time the Fed was talking about it, they were saying 2. It's early in the year, so we got the Fed minutes reported today where, like you were saying, it's going to be, they want to see some more progress on inflation here before they get to bring rates down. So, and every time Chair Powell is talking, he says, we're not in a rush, we're not in a rush, we're not in a rush. So I think we have to take them at face value because the whole last few years, they've been pretty transparent about what they're planning on doing. And he's saying we're not in a rush and the economy's holding up well enough where they don't have to be in a rush. So higher for longer really seems like a safe bet right now.
So why is Europe having a more soft approach, if you will? Is it just because their economy is significantly weaker or the metrics are completely different than what we're seeing in the U.S.?
They have worse trend growth than the U.S. Their kind of cyclical situation currently is also worse. So they just need more help from rates than the U.S. Needs right now. So we're holding up in the face of these relatively high rates, whereas the European economy has clearly been slowing. They haven't had the same kind of fiscal boost that the U.S. has had. So they need rates to come down to support their economy a bit more.
Yeah, Chris, it just feels as if uncharted territory a bit here. I mean, think about it, we're only 5 years out from the pandemic. There really is no roadmap for that. And then, of course, we have an unsure policy environment. And I would argue that what's happening with fiscal policy is a little bit more scary to me than what the Fed is doing right now.
Well, and again, to your point, it's the known unknown. We don't know how the rest of the year is going to play out. We don't know if we're going to have black swans. We don't know if there's going to be a liquidity event. I think one of the things that's happening over in Europe is that they have not seen the inflation that the U.S. has seen. And so you're going to get this bifurcated trade where the U.S. is very concerned about inflation reigniting and going back to 7, 8, 9%, while the Europes are like, hey, we need a little bit of inflation to get, keep from disinflating. And then you throw the China card on top of it, where the Chinese are like, hey, we've been kind of struggling with slow growth. How do we reignite that all over again? And it really wraps all together. We're saying, okay, there's value in overseas. Is it going to be time to go there? But again, to your point, you got to diversify. And I see too many investors either I'm all in on cryptocurrencies, which cryptocurrencies was supposed to be the new gold, where a lot of people are like, hey, we got to be in cryptocurrencies. Gold is for boomers, and all of a sudden cryptocurrencies have kind of leveled off. And I think a lot of the markets, fixed income, equity, are all trading sideways the last couple of months, trying to figure out where the next, where money's going to go next.
Yeah, well, I mean, it's a good point that you make about digital assets. At the end of the day, I think the market's recognizing that it's more of a utility than anything else. As the infrastructure and as policy forms around that, we tend to think very U.S. and Western-centric in terms of what's this valued at, how do I hedge with it, how do I trade it? But the fact of the matter is, it's the infrastructure that's allowing for alternative forms of capital formation, commerce.
I agree. Let's be very honest. Just calling the digital asset space that is one way to refer to it, but you really need to start getting into the specifics around what you're really talking about. If it's a cryptocurrency or specifically Bitcoin, you're going to trade news, you're going to trade announcements, you're going to trade emotion. It's still very concentrated on people who we don't know who they are, and it's a risk asset, full stop. Now, they're going to cherry pick in the crypto Bitcoin space correlations and volatility data that suits what their narrative is for the day. And it's literally by the day. But when you step back and look at long trending data where you can rely on it, including volume data, you're going to find that it's a risk asset and it's got a place in your portfolio in risk. It's not an offset. Then when you get into the world of other digital applications, stable coins or non-fungible tokens or central bank digital currencies, all with very different use cases and different dynamics. And hopefully this will be the year that we start to see some clarity out of Washington around how to parse this out, what needs to be regulated, who should be involved in the regulations, and where we can go. Beyond what we're getting right now, which is a lot of tweets, a lot of noise, and the emotion that's moving the price on some of these assets, in particular Bitcoin. Like when Elon Musk puts tweets out to talk about whether there's gold in Fort Knox or not, you wonder why. You wonder why. Is he trying to drive up something or drive down something or just drive something in general or just create some fun in the market?
Makes you wonder, like, if there's chaos being created for, I mean, this is very like tin foil hat, for a bigger, more robust issue, if you will. But I would agree with you, Joe. I feel as if we isolate the infrastructure part of digital assets, that is what's going to drive the underlying mechanism of the global capital markets going forward as it becomes more, I would even say electronified, but digitized.
Absolutely.
And that's the trend that it's going in. So I think there's a big distinction there.
All markets are actually involved in it heavily. Like we had pilot programs we ran last year using digital applications of gold in new forms of collateral applications, very successful. And we're on track to do those types of pilot programs in the wholesale gold market this year. So it's really exciting stuff. But it isn't cryptocurrency, and we're not saying we're going to replace Bitcoin. We're simply saying new mechanism for application of gold, new mechanism for people to access gold, starting with the wholesale side of things, and then let it continue to develop in the right way. By the way, in a market that's regulated on the instruments that give you access to gold and understood by the market in the OTC sense. So we don't need to rewrite regulations in Washington like some people would claim.
We could have that conversation all day long. Chris, in the last minute here, client, they're talking to you, what do I do? How do I know when the shoe drops? Do you keep long and stay invested and rational about this market?
Yeah, I mean, it's very difficult. So, and I know this tried and true. We keep coming back to, hey, you got to do some dollar cost averaging. I mean, you know, markets are all-time highs, S&P 500 hitting new highs. It's very difficult to buy these overvalued markets, but again, they can get even more overvalued. And so, you know, we come up with a game plan. Fixed income is an attractive asset class. I say, take the income off of your fixed income, roll it into different equities, create a diversified portfolio, small, mid cap, international. You know, we're favoring value and dividends right now. And actually, if you look at the returns so far this year, besides international doing really well, you know, dividend stocks are having their heyday led by, you know, the banks. And so, you know, you can always find a place to have investments. We're just trying to keep people, and we said this after the election, from going all in one particular area, saying, well, this is going to be the winner. We don't know what the winner is going to be in 2025. And so once again, you got to have a diversified portfolio. And, you know, if you're betting on the Super Bowl and your team to win the Super Bowl, you got to be very realistic. Are they going to win or are they not going to win? Kansas City won the last 2 Super Bowls. Guess who just won the last one?
You don't want prop bets in your retail account? No?
I would not go that way.
All right. Appreciate everyone's insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.